Dreamit Ventures has been investing in great early-stage startups for over a decade. The Dreamit Dose allows us to share best practices to help even more founders. Tell us about your great startup using the links below. Welcome to the Dreamit Dose. I'm Steve Barsh, managing partner of Dreamit. Every year, we talk to dozens of startups going through the M&A process, and we see a very common set of mistakes that have occurred before they get to M&A and through the process. Today, we're joined by Alejandro from Terra Advisors, who has a lot of experience in this space. Alejandro, thanks for joining us today.
Well, thank you for having me. So essentially, my background is I'm an entrepreneur, former recovering lawyer, I would say. Then I went at building and scaling companies. The last one that I did, that was a venture-backed company where we did the whole building, financing, scaling, and exit. And then after that, I created Terra Advisors with my partner, who actually was the investment banker that we used on that transaction that I did. And besides that, I have written several books, The Art of Startup Fundraising, Selling Your Startup, which actually is very timely for the discussion that we're going to have now. And then also I have this podcast called Deal Makers that is already at over 2 million downloads, where basically I interview super successful entrepreneurs. And today here, we're going to be talking about the top M&A mistakes.
So let me guess, the first big mistake that startups make is they don't get the maximum value dollar figure for their startup.
I mean, basically, that's what really happens at the end of the day, Steve? I mean, I think that the problem that startups really face here is that when they're raising money, because people nowadays, they think that raising money is being successful, but always with money in, there's expectations for money out and also for money out with returns. And when startups are taking that money, they essentially don't know, how they can really put themselves in order to really be successful down the line. So always those funds, they're going to want that 10x return. So when you're getting that money in as an entrepreneur, you need to know that you need to provide those returns to those investors. Otherwise, when you get that inbound acquisition offer and you think that, it's going to be exciting and all of that stuff, you may get one of those investors that are going to turn the whole thing down because they're going to be at a board level. They're not going to like it and they can completely reject the offer. I've had people and friends that received a $100 million offer. The investor was not happy. They controlled a bunch of board seats. They declined the offer. And literally just a couple of years later, the company ended up being a fire sale for just $2 million. So it happens. So founders always need to know that with money in, there's money out that comes with the expectations of at least a 10x return.
So is a way of rephrasing that or a way of thinking about that entrepreneurs and startups need to understand when a VC is investing in a startup, what the expectations that VC has of the return, like you said, a 10x return, which means as they take more and more early stage money in, they have to realize what that exit multiple needs to be. And for instance, if you raised 50 or $60 million, $100 million exit isn't going to be nearly big enough to get that investor to say, great, let's go ahead, we'll prove that exit. Is that another way of saying that?
So 100%. So the founder really needs to know that. And in many instances, unfortunately, you see founders taking money, and the problem when you take money in and you increase the valuation, you're also reducing the potential acquirers, because the higher the valuation, the lower the people that are going to be able to afford to buy you out. So it doesn't mean, you see this all the time, many founders that haven't raised that much money that can really make a killing because they own much more equity of the business versus raising a ton of money and reducing that pool of investors and potentially having people on your board that can kill the deal.
So Alejandro, how would you paraphrase then, what's the first big mistake that startups make?
The biggest mistake is not starting with a finish in mind. Because this is all about really understanding where you want to go and really reverse back engineer the process to where you are today and take immediate steps in order to get there. And that is obviously the way that you take money in, because the way that you take money in today is going to impact the way that you can take money in tomorrow. And then also the way that you can also do the exit of your own business and give the returns to you, to your family, to your employees, and to your investors, and all of those people that actually placed a bet on you.
The next thing I thought maybe we could talk about is we see a lot of startups that are almost raising and trying to exit at the same time. Do you see that leads to issues?
That's actually a massive mistake, Steve. And the reason for that is because the way that you tackle raising capital versus the way that you tackle really like pursuing an exit, doing an M&A transaction is completely different. On a fundraising round, you essentially have everything figured out. You have all the answers. You have everything that the investor is asking you. Versus being on an M&A process, you have everything on figured out because it's not your idea. It's the idea of whoever is acquiring your business. So obviously the way that you're going to be positioning, packaging the story is going to be different. And essentially when I see that companies try to do both, they fail at both. So you need to pick your lane and go all in.
Okay, got it, Alejandro. Pick one. Okay, what do you think is the next big mistake startups make during the M&A process?
Well, without a doubt, Steve, the biggest mistake that I see is the way that founders are approaching stock versus cash type of transactions. Because obviously stock is very much, depending on the future growth, on the potential results and milestones that company that is acquiring you is going to accomplish versus cash, being able to have that on hand. And it's what you have is right away, you're going to get that. But in many instances, all these founders get lost with all these millions of dollars that are put in front of them. And they need to really realize that when it's given in stock, it needs to have certain events that need to happen in order to materialize. I think that as a founder, you've taken a lot of risk leading up to that LOI, which is essentially summarizing up the terms of the transaction. So try your duty and your biggest responsibility as an entrepreneur is to try to de-risk as much as possible the transaction. And for that reason, you need to try to add as much certainty as possible and try to pick, perhaps more cash versus less stock, or perhaps also look at the way that they are structuring the earnouts, because in many cases, those earnouts too are going to come and bite you in the end. You need to always try to the risk and always go for certainty when you're looking at structuring the deal. So a good example of this is, for example, the WeWork story, right? So WeWork was going to IPO. They were on an acquisition spree. They were buying companies left and right. And then what happened? What happened is that all of a sudden, all these articles came out around the culture of WeWork, around what was going on with the business, and the company literally imploded. The problem with that is that all those transactions that they did were in stock, whether it was companies like Meetup or others, they were in stock at a valuation that was astronomical versus where they are now. So the problem with that is that investors are stuck holding the bag. And what's going to happen most likely is down round events that are going to continue to diminish the valuation of the stock that you were promised.
Okay, Alejandro, so we talked about deal structures. The next thing I thought we could talk about is it seems, let's say even get that deal structured correctly, that most M&A deals fail to meet post-merger expectations.
Yeah, so that's absolutely right, Steve. So most M&A transactions, they fail in the integration. And the reason for this is because there is no clear alignment when it comes down to the way that they are discussing around LOI or during the due diligence process between all the teams that are going to be part of the execution of that integration process. So the mistakes that startups make is ultimately having a lack of alignment with the potential buyer. And that lack of alignment starts at the beginning when you're going through the LOI, when you're going through the due diligence process, where all the teams are meeting together, where you have that great discussion. There needs to be clear alignment on all ends and to have a clear understanding too of how that integration is going to unfold. So as a result of this, the problem that I see is that the deal closes and then all of a sudden, it's like a wild, wild west. People don't know what they need to be doing. There's no clear alignment. Ultimately, everyone is frustrated and the deal ends up blowing up during the integration. And that is essentially why most of these deals, unfortunately, they fail.
Alejandro, I hear what you're saying, but I've been through M&A several times myself personally with companies I've done. The problem is, for what you're saying, is everybody is selling, right? The startup is selling to the acquirer. The acquirer is basically selling back to the startup. Everybody's excited. Lots of money are on the table. It's very passionate and very heated. How during that process do you have any level of sanity to make sure there's alignment while everybody is selling everybody else?
You are absolutely right, Steve. The big problem that I see is that founders don't make enough due diligence. And what I mean with this is that when you're on the right side of the mountain, everyone loves everyone. But this is like dating. But when you're on the wrong side of the mountain, you start to see the fogginess, people, not having food. You get to see the real human being. So I find that for founders, the biggest mistake is they should go and speak to other people that have done deals with those potential buyers. And vice versa, perhaps. So just to make it tangible for everyone, Steve. I mean, for example, in fundraising, which is what most people that are watching us are used to. When you are about to close the deal with an investor, you need to ask the investor for an introduction to a founder that they have invested in that failed. So obviously, when you're speaking with a founder, they're going to tell you how they behaved during the tough times. Did they roll up their sleeves and did whatever they could to try to help in turning everything around? Or did they treat that founder as a write-off so that they could allocate that time with other companies that were performing better? I think that that's a great example that happens in fundraising, and just the same way it should be applied, when you're doing acquisitions as well.
Okay, coming off of alignment and due diligence, how do you think about cultural fit between the acquirer and the startup?
I mean, not understanding the culture, of the company that you're going into is a massive mistake. I find that, founders start thinking about the numbers and the transaction, the exit, and all that is great. But you've worked very hard for this to happen. You've worked very hard, and you owe it to yourself. You owe it to your employees too, to understand where you're going. What is going to be that home that you're going to be now joining? Where you're going to have to work very hard as well for doing what they call, in a fun way, the vesting and resting, which is to really earn that money, those earnouts that you're going to have to really execute and achieve those milestones. And in many instances, I see founders that they don't put the extra time to really get to know those people, to really get to know, what are they passionate about? What gets them out of bed every morning? And really understand, whether or not there is a good synergy there with your culture, with your principles, with the way that you build your own company, with the way that, your employees are thinking about execution. And unfortunately, without having that in place and without really understanding what you have in front of you and in that company, you're going to see a massive catastrophe waiting to happen.
So Alejandro, we've talked about deal structure, culture, everyone selling to everyone. I mean, people are so excited and they're so passionate. Does in and of itself, all of that lead to other mistakes?
Well, 100%, Steve. I mean, obviously, when you get that investment of yourself and time and your people, into the deal, then you become emotionally attached to really getting that outcome. You start to dream of it. You start to think about the car that you're going to buy. And the problem with that is that you make mistakes. If they try to pull a card where they're trying to negotiate you down because they found whatever on the diligence process, then you're going to be acting desperate, giving in, all of that kind of stuff that is going to be a big turnoff. So what you need to do as an entrepreneur is always being completely unattached to the outcome. And if it's not them, it will be someone else. Because this is like being in the desert. If you're giving someone a water and it's not open, the more that they get thirsty, the more that they're going to want to open that water. And the same thing happens when it comes to deals. You have that water and you got to get them super excited and to open it like even more and more and more. And that is essentially the way that the entrepreneur needs to behave. They need to be completely unattached and always think that things are going to be always working out, whether it's with them or with someone else. And always, always, always avoid really coming with a signaling of weakness, because that is what essentially happens. You need to be unattached, and ultimately that is going to signal strength. And people are going to be very, very attracted to that.
So Alejandro, you and I have talked many times about topics like this. And I think a great last mistake that we could talk about is what happens when startups aren't emotionally unattached. When they're really emotionally attached, do you see a big final mistake that startups make?
Absolutely, Steve. Without a doubt, the biggest one that I see there is when someone renegotiates the terms and when they give in. When someone is renegotiating the terms, that's essentially a super red flag. Because if you're already getting that lack of trust, that lack of alignment right there when you have the terms and where you've already agreed perhaps on the LOI and you're moving on towards drafting up the asset purchase agreement, if they are trying to renegotiate stuff that was already pre-agreed before, that's a massive no-no. And I find that especially if you're doing either a partial exit or a stock type of acquisition, you want to make sure that you're going in with people that have integrity. They need to be people of their word. And if you're getting those type of renegotiations last minute or later on, you gotta, put your foot down and you need to walk away. You need to walk away.
Thanks, Alejandro, for going over all of those mistakes that startups make getting through the M&A process. It was really insightful and really helpful. Thanks for pointing all of that out.
Well, thank you so much for having me. Have a lot of respect for what you're all doing with Dreamit, and it was an honor to be here with you all.
That's it. That's Dreamit Dose. Please leave your questions in the comments section. If you like this video, please make sure to like and subscribe. We have a lot more coming. Check out all of our Dreamit Doses at dreamit.com/dose. See you next time.